And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Joe Bozoyan, CFA Portfolio Manager at Manulife Investment Management, with approximately 5.5 billion in assets under management. Joe, thank you very much for coming on the show.
Oh, thank you, Adam. I appreciate it.
So, Joe, I'd like to begin. If you can tell us a little about your story and how you got involved in the business, we'd appreciate it.
Yeah, sure. I really started out at the bottom of the investments business. I always had an interest in investments. I participated in the stock club in high school, and I pursued a degree in finance in college. I graduated college in '89, which was a tough period economically. So there really weren't all that many jobs in the investments business. The only jobs that were available were on the administration side. So essentially, my first job was at a transfer agency company, essentially processing buys and sells for mutual funds.
Nice.
So that was a good entryway into the business. I was able to learn a fair amount, but I also realized that wasn't the part of the business that I wanted to pursue long term. So I went to business school locally here in Boston, at Boston College, and in my second year at business school, I was able to get an internship at a mutual fund company called Eaton Vance in their municipal bond department. That was a good experience. So I was able to kind of take that experience and get a job after business school with Sun Life Financial as a corporate bond analyst. So I spent about 8 years at Sun Life. My first 3 years as a bond analyst covering the utility sector, energy sector. And then there was an opportunity to go on the equity side of things at Sun Life, which I did, and spent 5 years on the equity side of things at Sun Life, covering, again, energy utilities. I also picked up the REIT sector. So then I took a couple other jobs as equity analyst. I've been with Manulife Investment Management now for just over 9 years. Again, starting out as an equity analyst, but then over the last 5 years, I joined the preferred team here as a portfolio manager, as the co-PM with a senior portfolio manager. And then over the last 2.5 years, I've been co-lead portfolio manager for our preferred strategy here.
Nice. So that's a perfect segue to my second question. Please tell us a little about your investment strategy and how you play the game.
Sure. Yeah. We manage 7 funds here, 5 public John Hancock closed-end funds that are income-oriented funds, and about 3/4 of the assets are in preferred stock, and then the other a quarter is in common stocks of high dividend paying companies, like mostly utilities, frankly. So those are 5 levered closed-end funds with average dividend yield of about 6.5%. The leverage kind of boosts that dividend yield. And then we have a couple other offshore funds targeting the Asian markets that are pure preferred funds and don't have any equities in them. So we think preferreds are really attractive asset class. It's sort of overlooked. We think that they should be part of someone's portfolio. They offer very compelling yields, similar in yields to high yield bonds. But the average high-yield bond credit rating is single B, whereas the average credit rating for preferred stock is triple B or investment grade. So you're getting a fair amount of yield without taking on as much risk by buying preferred stock. So we really like that about the space.
Sorry, by
buying quality companies.
By buying preferred bonds, you mean?
I'm sorry?
You said by buying preferred stock. You mean you're taking on risk instead of buying preferred bond, but instead of buying bonds, you're buying preferred stook.
Yeah, instead of buying high yield bonds, you're getting similar yield,
right?
But you're not taking on as much risk. Preferred stock is just really a different part of the capital structure. It's below junior subordinated bonds. So you typically don't have lower quality companies issuing preferred stock because investors just don't want to take on, buying a subordinated piece of paper from a high yield company. So you typically have your large cap banks, JP Morgan's, Bank of America's. Then you have many of the utilities they're also issuers of preferreds. So you generally have these large cap, well-known, established companies that have been around forever with strong balance sheets that issue preferreds.
Got it.
So we like that.
So that makes really good sense. And the fact that, like you said, it's often overlooked, that's also offers a lot of opportunity because most people just aren't even looking. So where they buy the common stock or the bond, but they wouldn't necessarily look at the preferred in most cases.
That's correct. Right. Yeah.
Understood. So how do you handle risk, and what mistakes do you see people make with respect to risk management, Joe?
Yeah, I think the way we handle risk for our portfolios, again, we really have this focus on quality. Every name we look at, we have several items we look at for characteristics of a security that we like. We like, as I mentioned, enduring business models. So, your financial services companies that have been around forever, your utility companies. We also really look for companies with strong balance sheets. And then also companies with sustainable free cash flow and solid management teams. So I guess the answer to your question, the way we would handle risk is just by focusing on quality companies, which tend to outperform during volatile market times. So I guess that would be sort of the way we would handle it.
Okay, and then so is that more towards looking at the balance sheet and the fundamentals of the businesses themselves, opposed to the actual performance of the stock?
Yeah. So right. So I guess I kind of view risky investments as ones that aren't often quality companies or have bad balance sheets or have other risks within the company. So I guess the way we really have that focus on quality, which we have shown that helps us outperform over the long term, particularly during turbulent market times.
Understood. So it's more along the fundamentals line than the technical line. In other words, you want to find good businesses opposed to seeing how the stock performs. And if the stock drops, it's not necessarily a concern as long as the business fundamentals are still good. Is that correct?
That's correct, yes.
Gotcha.
Yes.
So I guess, Joe, what are some timeless lessons you've learned along the way that you'd like to share with the audience?
Yeah, I guess, one of the things that I've learned over my years of investing is that, don't think that you're smarter than the market. Often, if you see a security that is looking compelling or cheap, there's often a reason why that's the case. And to ignore these signals that the market is giving you is, I think, a mistake. And so if you find an investment that you like, but the market is telling you that there might be some risk here, I think you really need to understand those risks and make sure that you understand them so that you don't make a mistake with that investment. So I guess just ignoring the market signals is an important lesson I've taken through my years of investing.
I love that point. And then I kind of guess that raises another question. Just previously you had mentioned that you look more at the fundamentals and the technicals. And if you're going to say listen to the market, wouldn't that mean that you'd listen more to the technicals and how the stock's trading? Or am I misunderstanding something?
Yeah, just looking at valuation and also technicals of the market, yes. We do like on the equity side some more of your value plays, and sometimes you don't want to get stuck with a value trap. So you want to make sure that you're seeing something, or you're understanding the risks that the market is telling you is in the investment.
Okay. That makes sense.
And so, yeah.
So as long as you're understanding the risks associated, if you look for value, deep value, or whatever the case may be, even if it's beaten down, but as long as the metrics are there from a fundamental standpoint, you're happy more, and then you'll put more of a emphasis on that opposed to the actual way the stock is trading. So if the valuations are attractive, understood. Okay, that clarifies it. Thank you for that. So I guess the next question, Joe, a lot of people come on the show and they talk about value, and Buffett talks about value and undervalued. Value, like beauty, is very subjective. How do you determine value, and what traits do you look at to find something that's quote unquote undervalued or being mispriced by the market?
Yeah, I think when looking for value, you really want to look at the actual quality of the business. A space that we think is interesting here is the midstream energy space. Many of these companies are own pipelines that transport oil or gas on their pipelines. So they're valuable pieces of infrastructure that can't be replaced. You really can't build. It's really difficult to build new pipelines these days. So I guess from the standpoint of just looking at the business, these are businesses that are going to be around for years to come. But in some cases, we're seeing, we think these investments or these businesses not being given the correct valuation in the marketplace. These are companies with long-term contracts often and generate lots of free cash flow. And given that you're seeing increased demand, particularly for natural gas in the U.S., these are valuable assets that you really can't replace. So there's the replacement value is a lot higher than where the market value is in many cases. So I think that's a big part of it. And also just looking at good management teams and strong balance sheets.
So I guess from a value, like I'm just curious, and the listeners, I get a lot of questions after the guest comes on and says, oh, well, look for undervalued or strong balance sheets or look for valuations. Do you look at metrics like PE and you look at trailing PE? Or do you look forward PE to determine value? Or do you look at it, all the valuations in a group and look at all the banks, the PE, average PE ratio, let's say, is the teens, and you find one that's in the low teens or high single digits that'll be undervalued, or do you compare it to the market? I guess if you can speak a little bit about how to determine value opposed to a value trap, that'd be just shed some light on that topic, that'd be very helpful.
Yeah, sure. I think there's many different ways to kind of look at valuation. Certainly we'll look at PE. Also look at enterprise value to EBITDA, which kind of incorporates the debt that a company would have on its balance sheet. So we look at those metrics versus its peer group, and also how they've traded versus the market over time. But also I think, and also you can do, in many cases, particularly with these midstream energy companies I was talking about that generate lots of free cash flow, you can also do a discounted cash flow analysis with many of these investments as well. And also you can do some of the parts, because there might be different parts of the midstream business that these companies have that trade at different multiples. So I guess if you can kind of triangulate all those different valuation metrics, and that's what we do to kind of determine whether we think something's undervalued or not.
Got it. That's very, very helpful. Thank you for that clarification. So I guess, Joe, next question for you is, what mistakes do you see people make in this business, and how do you avoid them from an investing or trading standpoint?
Well, I think one thing I see investors do is maybe they tend to chase investments. I think it pays to be patient often with looking at something, and just because everyone is on board with the name and likes it and it's trading up, I think it sometimes can pay off to just to be patient and look for the spot where you would really feel it's an attractive investment for you. I also mentioned the fact that don't think that you're smarter than the market. I've seen people do that where they think everyone else's take on an investment is incorrect and theirs is correct, and that can sometimes bite them and hurt them in the long run. So those are a couple of pieces of advice.
Gotcha. That's very, very good. So those are some mistakes. So what about the best piece of advice you can share with the audience, in the market or out of the market?
Yeah, I think you, in terms of looking at your portfolio, not to get too caught up in what's happening in terms of the day-to-day movements of your portfolio. So I think you want to have a plan in terms of allocation to different asset classes and sort of stick with it through time. There might be, like, for example, there was a period in December of 2018 where particularly in the preferred land and also in most financial markets, you saw pretty big downtrends in preferreds and also in the equity markets. There might be some investors might panic somewhat and start to sell their investments. But I think if you have a long-term time horizon and you're comfortable with your allocation to different asset classes and you should stick with it. And I think that will help you in the long run.
No, I like that a lot. So I guess a few questions here, if it's okay with you, Joe, on preferreds and income. How does interest rate policy from the Fed impact your outlook and or investment strategy with respect to income and preferreds?
Yeah, it's a good question. We do have. We also listen to our in-house economists here, and we also look at research by other economists outside of our firm to try to get a sense of where we think the economy is heading, and also where what our view on interest rates are going forward. So if we were really preferred securities are long duration perpetual securities, so they do tend to be more sensitive to interest rate movements. So that's something we have to be aware of. So if we thought that interest rates were going to move up a lot in the next 12 months, for example, we would maybe have a little bit more cash. But one thing we could do is we could buy floating rate securities, and so we could really load up on those types of securities, which would help us mitigate the effects of higher interest rates. So that's I think now we're in a period where we think we're in a lower for longer interest rate environment. So we're comfortable owning these long duration perpetual securities because we think that they're attractive given where U.S. Treasury is and also where global yields are. And then there are also things we can do to hedge our interest rate exposure by using derivatives. We can short 10-year Treasury futures that can help us mitigate the effects of higher interest rates. So there's a couple tools we can use. We can also buy. We do have a bucket to buy some common equities in our portfolios, as I mentioned. If we thought that the economy was going to do really well, for example, we could buy some energy integrated oils with high dividend yields. In better economic times, oil prices tend to do better, and which result in many of these stocks doing well. So that can also help us mitigate the effects of higher interest rates. So a few tools that we use to help us.
Nice. So how does the economy or the economic outlook impact the decision making? So the Fed's interest rates, obviously, for income strategies is very, very linear and straightforward. How about the economy? If you're expecting, like last year around this time, everybody was negative on the economy, expecting a possible double dip, recession, or whatever the case may be, or just slowing growth, whatever. How does that impact your outlook from an investment standpoint?
Yeah, that's a good question. So I think in that case where a recession might be on the horizon, you would obviously have the Fed cutting rates, so that would result in lower rates, which would be good for fixed income instruments. The thing you have to worry about, though, is credit spreads widening, and that's again why we like quality companies. Particularly, and we have an overweight to the utility sector in our portfolios versus our benchmark and our peers. And we think that those offer a lot of nice yield, and it is not really levered to the economy really, because utilities are regulated and commodity prices are actually borne by the end consumer. So therefore, you have very little volatility in their utility earnings and cash flows. So those should hold up, and they have held up well during recessionary type periods in the economy. So that's how we think of it. If if we thought that was the case, we would maybe kind of take some of our portfolio away from the energy space and the financial services space and kind of put it more into the utility space, which is a space we know really well. We're already overweight.
Understood, 100%. So, and then the opposite, I'm assuming, would be true also. If you're expecting, if we're in a recession, you're expecting the recession to end and more, I guess, better economic times to come ahead, you should probably do the opposite.
We would do the opposite. Yeah, there are many interesting energy hybrid, essentially energy preferred names out there that offer a lot of yield. We could buy those. We could buy a little bit of energy common equities as well, and then there's plenty of financial services companies that we could buy that would do well in that kind of environment.
No, that's fantastic. So I guess final question I have for you today, Joe, just from an education standpoint, I love to learn, and preferreds and income is a great, like you said, often overlooked area. So while I have you, I like to just ask these questions for the audience to benefit as well. What about, in your opinion or your view, do you find a difference in like, what's your sell discipline? Do you sell when something's overvalued, if you're looking to buy when things are undervalued, or do you wait for a certain fundamental event to happen where the company's no longer quote unquote good, or is it a external economic event or market event, or
Yeah.
what criteria, if it's okay for you to shed some light on the selling side of it, both for a
Yeah. So,
profit and for a loss?
yeah, I think it's a lot of those things. If if the economic environment changes, or we think it's going to change, and that could make one security, for example, an energy company, if you thought we were going into a recession, we would potentially look to lighten up or sell a security that's in the energy space that we thought was very levered to the economy. And also we look at our sell discipline is this. We look at we have a thesis for each name in our portfolio. If there's a change in the thesis, that would also be a catalyst for a sell as well. If a company made an acquisition that we thought was not, that wasn't a prudent use of capital, and sort of that changed the thesis on the name, and then we would look to sell it. But we also have we look at relative valuation as well, particularly in the preferred space. So if it does hit that that yield target that we had in mind when we bought the security, then we would also look to sell it.
That's a good point. Can you elaborate a little bit on that relative how that works?
Yeah, I mean, if for example, a Bank of America preferred security, what's interesting about preferreds as well is that it could be somewhat of an inefficient market. So Bank of America, for example, can have 4 or 5 different issues.
That was kind of why I was asking for you to elaborate for that exact point.
Yeah, so they can have several different preferred issues, and just because of the inefficiencies in the market, they can create a different yields. So, for example, there might be one preferred that might be trading at 30 or 40 basis points inside of another Bank of America preferred security. So that would be certainly a catalyst for us to sell that, and maybe looking to buy another Bank of America preferred, or look at a JP Morgan preferred or a Citi preferred.
Got it.
So we're constantly looking at the portfolio, kind of looking at the relative value within the actual space, within the actual issuer, meaning like Bank of America, there's several issues that they have outstanding, but also looking at it versus other banks out there and their preferreds.
Got it. That makes perfect sense. And if one gets too high for whatever reason, relatively speaking, you might shift and rotate into a different one, depending on what's attractive for you at any given time. Well, Joe, this has been fantastic. Thank you kindly for coming on the show and sharing your story and your experience with us. And we look forward to having you on again soon. Before you go, Joe, what is the best way for people to get in touch with you?
I guess through my email, jbozoyan@manulifeam.com.
Okay, perfect. Well, thanks for coming on, and we'll talk to you again soon.
Great, thanks.